Welcome to the lecture on partnership accounting. In this lecture, we will discuss about dissolution of partnership firm and insolvency of a partner. First, we will discuss about difference between dissolution of partnership and dissolution of partnership firm. There is a difference between both the terms. Then we will discuss about accounting treatment of dissolution of partnership in books of accounts. Then accounts to be prepared. So, in simple terms, dissolution means to close down or wind up. There are many reasons of dissolution of firm, such as voluntary dissolution. It means all the partners collectively decide to close down the business. Duration of venture is expired. It means at the time of beginning of the firm, all the partners collectively decided to run a business for 5 to 10 years time period. At the end of particular duration, venture is closed down. Next, after completion of venture or goal, similar to joint venture, if all the partners came together to run a particular business and the goal is then achieved, so they may dissolve the partnership firm and continue running their own business. Next is government declared the business as unlawful or illegal business. At the beginning of the firm, the business was lawful and legal, but after a certain period of time, government declared to be unlawful or illegal. Then business has to wind up. And last, dissolution at will. If any of the partners decide to close down the business at their will, then 14 days notice is to be provided, subject to certain provisions such as all the business, all the liabilities are paid off, and there are no outstanding expenses which are payable. So there are many reasons of business to close down. There may be natural reason, or court gives order to dissolve the partnership. So in case of breach of agreement among partners, or court gives an order to close down the business as there are two partners and one of the partner became in unsound mind, then another partner cannot continue the business of partnership, because the meaning of partnership says that there must be minimum two members as a partner. So if one partner becomes unsound mind, he will not be able to sign a contract or run a business with another partner. So the partnership firm will dissolve. But there is a difference between dissolution of partnership and dissolution of a partnership firm. So let's check out the difference between dissolution of partnership and dissolution of partnership firm. So first point is dissolution of partnership will not result in dissolution of a firm. It means if there are many partners available in the business, and if any of the partner is retiring, so there will be dissolution of partnership relationship with the retiring partner, but it will not result in dissolution of a firm. So dissolution of partnership is not similar to dissolution of firm. There is a difference between both the terms. Dissolution of partnership will not result in dissolution of firm, but dissolution of a firm will end the partnership relationship. So, dissolution of a firm results in dissolution of partnership relationship. So, if business closed down, then there will be no relation among partners. Second point, dissolution of partnership can be voluntary, but dissolution of a firm can be voluntary or compulsory. As we have discussed that in the dissolution of a partnership firm, court may give order to close down the business, or business has become illegal or unlawful to continue. So there can be voluntary or compulsory dissolution of a firm. Even a partner can dissolve the partnership firm by giving 14 days notice, or after completion of particular duration a business can close down. So dissolution of a firm can be voluntary act or compulsory act depending upon the situation. But in case of dissolution of partnership, it is not compulsory act, it is voluntary act. A partner can retire from the business and dissolve the partnership relationship, but continuing partners will continue the business. So there will not be dissolution of partnership form. So dissolution of partnership is voluntary act, but dissolution of partnership form is voluntary or compulsory act. Remember, there is a difference between dissolution of partnership relationship and dissolution of a firm. Next point, continuation of business. In case of dissolution partnership, there will be continuation of business as well as continuation of partnership relationship among remaining partners. So, in case of dissolution of partnership, the business will continue. Even partnership relation among remaining partners will continue to exist. But in case of dissolution of a firm, business will not continue, business will dissolve. And even partnership relationship among other partners will also dissolve. Will not continue. Next point, we are required to prepare revaluation account to revalue the assets and liabilities of the firm. Assets and liabilities will be revalued at the time of dissolution of partnership relationship. At the time of retirement, death, there will be revaluation of assets and liabilities. But in case of dissolution of partnership firm, there will be realization of assets and liabilities. So we have to prepare realization account. Realization means assets are sold and realized in cash, and even liabilities are paid off. So there will be realization account or realization of assets and paying off the liabilities. A court may give order to dissolve a partnership firm, but court cannot give order to dissolve the partnership relationship. What will be accounting treatment in case of dissolution of a partnership firm? So first, dissolution expenses will be paid off. And even legal charges related to dissolution. Next, the business will pay off all the outsiders' liabilities. Outsiders liabilities means payment to creditors, outstanding salary, wages to employees and workers, to the suppliers, etc. Then, if there is a partnership loan given by any partner, then partnership loan, partner's loan will be payable, and at the end, the firm will find out the actual amount of profit or loss, and this profit and loss will be distributed among the partners among partners profit sharing ratio. That is profit and loss settlement among partners, and the books will closed. So generally accounting treatment in case of dissolution of partnership firm will be: first, dissolution expenses, other legal charges will be paid off. Then outsiders liabilities will be paid off by selling assets, sell the assets and pay off the outsiders liabilities. If money is in surplus, then loan given by partner will be paid off, and later on at the end, if the surplus amount is remaining, then it will be distributed among partners, and full and final settlement will happen. So this will be accounting treatment. Let's check what are the accounts to be prepared in case of dissolution of a firm. We have discussed at the time of admission of partner, retirement of a partner, or death of a partner, we have to prepare revaluation account. But in case of dissolution of a partnership firm, we have to prepare realization account, because the assets are sold and cash will be realized, and the cash will be used to pay off the liabilities. Then partners capital account or current account. If fixed capital method is followed, then partners current account will also be prepared, and if fluctuating capital method is followed, then only we have to prepare only partners capital account only. Then partners loan account, if partners have given loan to the business, and lastly cash or bank account. And what will be treatment of goodwill? So there is no requirement to provide special treatment to goodwill, as there will be no existence of goodwill because the partnership business is going to close down. Now let's check the format of realization account. Debit side, realization account, credit side. On the debit side, we will write to sundry assets. All the fixed assets will be recorded here. For example, land and building, plant and machinery, furniture and fixtures, etc. By sundry liabilities, all types of liabilities such as creditors, bank loan, etc. will be recorded over here. Bills payable, all the liabilities will be recorded here except partners capital account, because it will go in partners capital account itself. So creditors, bills payable, bank loan, etc. Then this amount will be recorded. The amount of sundry assets will be recorded at its book value, and liabilities are also recorded at its original price, which are given in old balance sheet. Then at the time of realization of assets in cash, we have to record it on opposite side, credit side, by cash or bank account. Those assets which are sold will be recorded on realization account credit side by cash bank account. and those assets which are taken over by partner will be recorded as by partner's capital account. For example, if furniture worth 80,000 rupees taken over by one of the partner at the rate of 50,000 rupees, then the amount will be recorded over here at the taken over price. So at the time of recording sundry assets, we have to write it at book value, the rate at which the assets are recorded in the old balance sheet. But at the time of realization of assets, we have to write by cash bank account. The amount will be the actual amount in which the assets are realized. For example, furniture worth 80,000 rupees sold at the rate 50,000 rupees. Then we will write two sundry assets furniture 80,000 rupees, but at the time of recording sales amount by cash bank account, we have to write furniture for rupees 50,000 because there is a loss of 30,000. If we write entries at the both the side, then there will be excess of 30,000 rupees on debit side. Therefore, automatically loss amount is recorded. Similarly, at the time of paying off the liabilities, we have to write as to cash or bank account and name of the liabilities, such as creditors are paid off, bills payable paid in cash. So the liabilities at the time of payment, we have to write it on realization account debit side to cash bank account, and second effect will be probably on cash bank account credit side by realization account. And if any of the liabilities are paid by any of the partner, then we have to write to partners capital account and name of the liability at which partners have paid. So similar to entry of asset side, we will provide entries for liabilities. And if any of the expenses such as dissolution expenses, legal charges paid in cash by business, then we have to write to cash bank account and we have to specify the expense name, dissolution expense or legal charges, etc. So there will be different entry of realization of assets in cash and paying off the expenses. And at the end, we will calculate the total of each side. And if balance comes on credit side, then there will be realization loss, and this loss will be distributed among partners in their profit sharing ratio. So by partners capital account, in bracket we will write realization loss and profit sharing ratio, and this balancing figure will be distributed among partners in profit sharing ratio. If credit side is higher than debit side, then there will be difference on debit side, and similar effect will be given to partners capital account and distributed among all partners in their profit sharing ratio, and this amount will be realization profit. We used to prepare revaluation account in case of admission, retirement and death, but in case of dissolution of partnership firm, we have to prepare realization account in which all the assets and liabilities are realized, and the difference amount will be distributed among partners in their ratios. So let's understand what are the accounts to be prepared and how it is to be prepared in case of dissolution of partnership firm. Illustration number 1. Riddhi and Siddhi are partners sharing profit and loss in the ratio 2:1. Two partners are there, Riddhi and Siddhi. Their profit sharing ratio is 2:1. The following is their balance sheet as on 31st March 2019. Assets and liabilities side is given. Building, furniture, machinery, debtors, less RDD, stock, investment, interest receivable and bank The amount is given on asset side. Capital account of Riddhi and Siddhi is given. Reserve fund is given. Remember to distribute reserve fund among all the partners in profit sharing ratio. Siddhi has given loan to the business, so we have to pay off the liability. Siddhi's loan account also, and creditors is given. The firm was dissolved on 31st March 2019. On the same day as on balance sheet date, the firm was dissolved. So this is the question of dissolution of partnership firm. Adjustment number 1, assets realized as follows. Assets are sold: machinery 22,000, building 28,000, machinery sold, building sold, stock 38,000 rupees sold, debtors 15,000 rupees sold. Second adjustment, Riddhi took over the investment. The investment account is taken over by partner, and furniture also. Furniture also taken over by Riddhi at book value. Book value means the value at which the furniture is recorded in the balance sheet. Second partner, Siddhi agreed to accept 3,000 rupees in full settlement of her loan account. Siddhi loan account is 4,000 rupees, but she agreed to take over 3,000 rupees in full settlement of her loan account. So we have to prepare Siddhi loan account also. Fourth adjustment is dissolution expenses amounted to 4,000 rupees. Realization account debit side to cash bank account. In bracket we will write dissolution expense. And last adjustment, interest receivable could not be recovered. The amount is not recovered. So this is just a information. All the adjustment will be done in bank account. Prepare realization account, partners capital account, Siddhi loan account, and bank account. So first we will prepare realization account in the books of Riddhi and Siddhi. Debit side, credit side. On the debit side, to sundry assets account, and on the credit side, by sundry liabilities account. All the assets given in the question will be recorded on debit side, and all the liabilities will be recorded in credit side. Even the reserve for doubtful debts, which are deducted from the debtors, will also be recorded on credit side. Then these liabilities will be paid off in cash, so to cash or bank account, and these assets are sold and realized in cash, so we will write by bank account. Those assets which are sold and realized in cash will be recorded under by cash or bank account, and those assets which are taken over by partner will be recorded by the partner's capital account. Then then whatever will be the remaining amount will be distributed among partners capital account in their profit sharing ratio. In the given question, the profit sharing ratio is 2:1 between Riddhi and Siddhi. So the realization loss will be distributed among both the partners in their ratio. Then we will prepare partners capital account. Riddhi and Siddhi, all the entries which are given in realization will be shifted to opposite side of partners capital account, and then we will prepare partners loan account and bank account. All the adjustments are made in banks, and ultimately bank account will need to be closed. It means the bank account, the debit side and credit side of bank account will be same, and final settlement of books of accounts. So let's start with the question and record all the assets on realization account debit side. So in the books of Riddhi and Siddhi, realization account debit side and credit side. First we will write asset side, building 60,000 rupees. On the realization account debit side, two sundry assets account. All the assets will be in inner column and total amount will be recorded in the outer column. Building 60,000 rupees, furniture 24,000 rupees, machinery 20,000 rupees, debtor original value is 17,600, and then RDD will be recorded on realization account credit side. The given RDD is 1600 in the question. Stock 40,000 rupees. Investment is also asset 8,000 rupees, and interest receivable 2,000 rupees. Other than cash or bank account, we will write all the assets on realization account debit side because we have prepared bank account separately. So bank account 20,000 rupees will be recorded on bank account debit side. Two balance brought down. This is the opening balance of bank 20,000 rupees. So we have recorded all the assets on realization account debit side at its book value. Then liability side, capital account Riddhi and Siddhi, it will be recorded on partners capital account credit side. By balance brought down, the opening balance of partners capital Riddhi 80,000 rupees, Siddhi 60,000 rupees. Reserve and surplus will also be distributed among partners in profit sharing ratio. So 16,000 rupees will be distributed in 2:1. So the amount will be 16,000 into 2 by 3. 10,666. To round off, we will write 10,667, and remaining amount, that is 16,000 multiplied by 1 by 3, will be 5,333 under Siddhi column. Siddhi's loan account 4,000 rupees will be recorded on Siddhi loan account credit side. By balance carried, by balance brought down 4,000 rupees. Remember, all the liabilities have credit balance. Therefore, we have wrote Siddhi loan account credit side opening balance. Creditors 30,000 rupees will be recorded on realization account credit side. By sundry liabilities account, creditors 30,000 rupees. Remember, the question balance sheet has only single effect, but all the adjustment have dual effect. There will be two entries in case of adjustment. So we have to write the same amount at two different places. First adjustment is assets realized as follows: machinery 22,000 rupees, building 28,000 rupees, stock 38,000 rupees, and debtors 15,000 rupees. The assets are sold and cash received, so the amount will be written in realization account credit side by bank account. Machinery is 22,000 rupees, building 28,000 rupees, stock 38,000 rupees, and debtors 15,000 rupees. Total amount will be in the outer column. And second effect will be on bank account debit side to realization account 1,03,000 rupees. 1,03,000 rupees. Realization of assets. So first effect we have given on realization account credit side by bank account, and second effect we have given on bank account debit side to realization account, and amount will be same. Second adjustment, Riddhi took over the investment at 10,000 rupees. So realization account credit side by partner's capital account, Riddhi's capital account, investment 10,000 rupees, and furniture at book value. Furniture book value is 24,000 rupees. Total amount will be 34,000 rupees in the outer column. Second effect will be Riddhi's capital account debit side 34,000 rupees to realization account. Third adjustment, Siddhi agreed to accept 3,000 rupees in full settlement of her loan account. So Siddhi agreed to take 3,000 rupees as full and final settlement. To bank account 3,000 rupees and bank account credit side by Siddhi's loan account 3,000 rupees. Fourth adjustment, dissolution expense amounted to 4,000 rupees. So dissolution expenses will be recorded on realization account debit side to bank account 4,000 rupees, and second effect will be bank account credit side, but we will write creditors amount also. Let's complete adjustment 5. The interest receivable could not be recovered, so no entry will be given because the amount is not given, and also interest receivable is not recoverable, it is not realized, so there is no transaction existing. So we have to close the books of accounts, but we have to first check all the assets are recorded on the opposite side and all the liabilities are recorded on the realization account debit side. Here no information about creditors is given in the question, so we will write to bank account creditors at its original price, that is 30,000 rupees. This is hidden entry. 34,000 rupees will be in the outer column, and second effect will be bank account credit side by realization account 34,000 rupees. This is realization of liabilities. Now let's calculate the total. First we have to bring all the amount from inner to outer column. Now remember, Siddhi had given 4,000 rupees as a loan to business firm, but the business has paid 3,000 rupees in full settlement. So there will be 1,000 rupees remaining to her, which is a benefit for the business because the liability is reduced by 1,000 rupees. So it will be recorded in the realization account credit side. Reduction in value of liability is a gain, notional gain to the business. Therefore, it will be recorded on realization account credit side. This is the balancing figure. So total is 4,000 rupees, and balancing 1,000 rupees will be transferred to realization account credit side by Siddhi loan account 1,000 rupees. Now we will calculate the total of debit and credit side. Debit side total is more, 2,05,600. It will be shifted to credit side 2,05,600. Then balancing figure will be recorded, will be realization loss, and it will be distributed among both the partners in 2:1. So credit side total will be deducted from debit side total 2,05,600 minus 31,600 minus 1,03,000 minus 34,000 minus 1,000. 36,000 rupees will be balancing figure. It will be distributed among Riddhi and Siddhi in 2:1. So 36,000 divided by 3 into 2, 24,000 rupees in Riddhi amount, and remaining 12,000 rupees will be in Siddhi amount. This is the realization loss. So partners capital account debit side, to realization account Riddhi 24,000 rupees, Siddhi 12,000 rupees. Then we have to close the partner's capital account. Credit side of both the partner is higher. So Riddhi amount total is 90,667 and Siddhi amount is 65,333. Both the amount will be recorded on the debit side, and debit side total will be deducted from total. So 90,667 minus 34,000 minus 24,000. 32,667 is the balancing figure in the column of Riddhi, and 65,333 minus 12,000. 53,333 is total of balancing figure of partner's capital account, that is Riddhi, that is Siddhi. So it will be recorded as two bank account. Riddhi will take over 32,667 and Siddhi will take over 53,333 from the business. 32,667 Riddhi and 53,333. Now we will close the bank account. Total is 1,23,000 and we have closed all the accounts. Bank account should be same, debit side and credit side should be same. So first we have recorded all the assets on realization debit, all the liabilities on realization credit. Bank account we have prepared separately, and Siddhi loan account and partners capital account is created separately. So the opening balance will be transferred to their respective accounts. Then assets are realized in cash and some of the assets are taken over by partner. So we have recorded on the opposite side. Liabilities are distributed. Liabilities are payoff. So the liabilities are recorded on realization debit side. The dissolution expenses are recorded and the amount transferred to partners capital account opposite side. Then partners capital account closed, balancing figure are transferred to bank account, and bank account debit side and credit side is same. Siddhi loan account was created and the balancing figure which are not payable to Siddhi is transferred to realization account credit side because it is a kind of notional profit. This is how accounts are prepared in case of dissolution of partnership firm. Let's take one more example. Illustration number 2. A firm consisting of a partner Mahesh, Suresh and Yogesh decided to dissolve the partnership. They decided to take over certain assets and liabilities and continue business separately. So the existing partnership business will be dissolved. The balance sheet was as under: as on 31st March 2017, assets and liabilities are given: furniture, sundry assets, debtors, less RDD, stock and cash. On the liability side, capital account of Mahesh, Suresh and Yogesh given, creditors and loan account. It was agreed as under: Mahesh is to take furniture and the debtors amounting to 40,000 and 34,400 only. He accepted the creditors of 12,000 rupees at that figure. So first adjustment, partner taken over assets and liabilities. Second adjustment, Suresh is to take over all the stocks and sundry assets worth 16,000 and 14,400 only. Third adjustment, Yogesh is to take over the remaining sundry assets at 16,000 and assume the responsibility for the discharge of loan. Together will accrue interest on loan 60 rupees, which has not been recorded in accounts. Then the dissolution expenses were 540 rupees. Remaining debtors realized in 4,200 rupees only. The necessary adjustments were made by partners to settle their accounts. Prepare realization account, partner capital account, cash account after giving effect to the above adjustments. So we will prepare realization account in the books of Mahesh, Suresh and Yogesh. Then partners capital account and cash account. First we will start the question with balance sheet asset side. Furniture 2,000 rupees. In the realization account debit side, two sundry assets account. Furniture 2,000 rupees. Sundry assets 34,000 rupees. Debtors original value is 48,400. RDD will be recorded on realization account credit side by RDD, or even we can write under sundry liabilities account 2,400, stock 15,600, cash 6,400 will be recorded in cash account debit side. Two balance brought down 6,400. It is the opening balance of cash. Liability side, capital account is given. Partners capital account credit side by balance brought down. Mahesh 55,000, Suresh 20,000 rupees, Yogesh 14,000 rupees. Creditor and loan will be recorded on realization account credit side by sundry liabilities. Creditors 12,000 rupees, loan 3,000 rupees. Total will be 15,000 rupees in the outer column. Similarly, we will adjustment number 1. Mahesh is to take furniture at 1600. Furniture worth 2,000 rupees taken over by Mahesh at the rate 1600. So we will write by Mahesh capital account furniture 1600. Debtor amounting to 40,000 rupees at 34,400. Total debtor is 48,400 and debtors amounting to 40,000 rupees is taken over by Mahesh at the rate 34,400. So balancing 8,400 is still available in the business. Total 1600 plus 34,400 36,000 rupees will be in the outer column, and second effect will be partner's capital account debit side, 36,000 rupees in the Mahesh column. Adjustment number next, he accepted the creditors of 12,000 rupees at that figure. Creditors of 12,000 rupees paid by Mahesh at 12,000 rupees. So this 12,000 rupees of creditor Mahesh paid off at same price, and second effect will be partner's capital account credit side by realization account in Mahesh column 12,000 rupees. Next, adjustment number 2, Suresh is to take over all the stock at 14,000 rupees. So stock of 15,600 taken over by Suresh at the rate 14,000 rupees, and sundry assets worth 16,000 rupees at 14,400 only. Total sundry assets is 34,000 rupees, and out of 34,000 rupees sundry assets worth 16,000 rupees taken over by Suresh at 14,400. So balancing sundry assets is still available in the business. Total 28,400 is in the outer column. Second effect will be partner capital account debit side 28,400 in Suresh column to realization account. Adjustment number 3, Yogesh is to take over remaining sundry assets at 16,000 rupees. Yogesh capital account sundry assets 16,000 rupees, and assume the responsibility for discharge of loan. Together will accrue interest on loan of 60 rupees, which has not recorded in accounts. So Yogesh will pay the amount of loan worth 3,000 rupees along with interest of 60 rupees. So total 3,060 rupees will be paid by Yogesh. So realization account debit side, loan 3,000 and interest 60 rupees to Yogesh capital account 3,060 rupees. So we will write both the entries. First, partner capital account debit side to realization account 16,000 rupees in the column of Yogesh. The remaining sundry assets taken over by Yogesh, and liabilities worth 3,060 rupees paid off by Yogesh. Adjustment number 4, the dissolution expenses were 540 rupees. Dissolution expenses are recorded in realization account debit side to cash account 540 rupees, and second effect will be cash account credit side by realization account 540 rupees. Fifth adjustment, the remaining debtors realized 4,200 only. So realization account credit side by cash account debtors realized at the rate 4,200 rupees, and cash account debit side to realization account 4,200. Adjustment number 6, the necessary adjustment were made by partners to settle their account. This is just information. No entry will be affected. We will close first realization account. Realization account debit side is higher. Total is 1,15,600. Total of debit side is higher. So 1,15,600 is recorded. Then total of credit side will be deducted from the total. So 1,15,600 minus 15,000 minus 2,400 minus 36,000 minus 28,400 minus 16,000 minus 4,200. Balancing figure is 13,600. So balancing figure 13,600 will be distributed among partners in the profit sharing ratio. In the given question, profit sharing ratio is not given. So we will assume that all partners are equal partners. Hence, we will distribute realization loss equally among partners, and it will shift to partners capital account debit side. Credit side of Mahesh capital account is higher, 55,000 plus 12,000 rupees, 67,000 rupees. It will be shifted to debit side, and 67,000 minus 36,000 minus 4,500, 4,533, 26,467 will be balancing figure. So balancing figure of Suresh and Yogesh will be 12,933 and 3,474 respectively. This amount will be shifted to cash account debit side, 12,933 and 3,474. Total amount of debit side will be 27,007 rupees, and cash account is also closed. Total of debit side is equal to credit side. Realization account debit side, first we will write all types of assets other than bank account, because we have prepared bank account separately. All the liabilities will be recorded on realization account credit side, and the amount will be book value. Only partners capital account will be recorded in separate in the separate account. Then assets realized in cash will be recorded on the opposite side of realization account by bank account. And if any of the asset is taken over by any of the partner, then partner's capital account will be credited. And if liabilities are paid in cash, then realization account will be debited with to cash account. And if any of the liabilities paid by any of the partner, then partner's capital account will be debited. Even dissolution expenses or legal charges will be payable realization debit side to cash account, and second effect will be cash account credit side by realization account. The balancing figure will be transferred to partners capital account in partners profit sharing ratio. Then partners capital account will be closed and balance sheet figure will be transferred to cash account, and ultimately cash account debit side will be equal to credit side. And this is how we prepare accounts under dissolution of partnership form.